Good morning, happy Good Friday. Jordan Keck here, your lender buddy with your weekly market update. It is Good Friday here. We got some interest rates coming down a little bit from 6.62% last week, and that's for best case scenarios, down to 6.45. So heading in the right direction, definitely not close to where we were at the 5.99 mark just a few weeks ago, but hopefully continuing in that direction. As far as our weekly mortgage tip, wanting to talk as we're coming up on the tax deadline here of April 15th about self-employed tax return requirements. So if you've got clients who are self-employed, this is something that you might be running into, helping advise them here soon, because if they do not have their tax returns filed by April 15th, they're going to be closing after that. Their underwriters might require them to have either their tax returns for 2025 filed or they might require proof of an extension. Now, one of the things that you need to know on this is if somebody files their federal tax returns, they're self-employed, so we need to see copies of those tax returns, then any amount that's due for federal taxes will be required to be paid before closing or at the time of closing. So if you know you've got a client who's self-employed, who's going to owe a lot in federal taxes, make sure to take that into account, because unfortunately I've seen times where that can eat up somebody's earnest money, it can eat up somebody's down payment requirements. So just something they want to factor in ahead of time, whether they're planning on filing or extending. There's some new guidelines that just came out from Freddie Mac that say that they're giving a little bit more time, up basically until the end of May, that if their application was before April 15th, they don't necessarily have to show that updated filing. They don't necessarily have to file until May 31st. So a little bit of grace there. Another cool thing is for most conventional guidelines, if the client has been self-employed with that existing business for 5 years or more, oftentimes you can just use 1 year of tax returns, the most recent one, rather than averaging it off the last 2. So some really cool features there. This is one of my specialties, is working with self-employed clients and a number of bank statement and 1099 loan programs as well. If you've got a client that's self-employed, writes off a lot, and doesn't have so much to show on paper, happy to help in those situations, so let me know. As far as the news this week, starting off here, the biggest market factor is, of course, the situation in Iran. Early in the week, Trump said he's willing to end the war even if the Strait of Hormuz is going to remain closed. This is a big thing because the markets were rallying with the idea that the U.S. might end the war early, not have to worry about the Strait of Hormuz. But as we've seen, the situation is still very fluid, very volatile, and can change quickly. Later in the same week here, Trump said that the strait is not America's problem and that the nations that depend on it should secure it, but he also suggested that other countries should buy oil from the US. Markets took this as an expectation of more conflict over the next 2 to 3 weeks, as he's putting more language into saying that they need to resolve quickly, otherwise they'll face consequences. And of course, this caused oil prices to go even higher as a result. Next, we saw the University of Michigan's Consumer Sentiment Report fall sharply from 57 to 52. This is the weakest components of the report were in employment. Those who felt that unemployment rate would be higher over the next 12 months rose to 61%, and those who felt that the unemployment rate would be lower in the next 12 months fell to 13. The spread between the two at 48% right now is something you don't normally see unless we're in a recession. The bond markets reacted favorably to this and have reduced their estimate of a rate hike this year in response, down from as much as 50% to about a 7% chance that we see a Fed funds rate hike this year. Next up, the JOLTS job openings report came in for January, only showing 6.9 million, which is below estimates. And then the previous report was revised higher from 7 million to 7.2. The internals were pretty weak, with the hiring rate falling to 3.1%, which is the lowest since 2011 when removing COVID. And then the quit rate fell to 1.9%, which is tying the lowest since 2014 when removing COVID. And the quit rate being low, that's more of an indicator of employees not being recruited away to other companies as much, showing that there's just not as much poaching, not as much strength. And of course, we're seeing that in the amount of income for clients, for borrowers. For employees who are leaving their companies versus staying, the increases for both of those are down significantly as well, especially since COVID. Next, we have Chiller and FHFA appreciation for January, showing home prices up 0.2 and 0.1% respectively. Year over year, home prices rose 0.9% for Chiller, down from 1.1 in the previous report, and FHFA shows home prices up 1.6% year over year, down slightly from the previous report as well. And lastly here, the March BLS Bureau of Labor Statistics report came in showing 178,000 non-farm payroll jobs created, almost 3 times the estimate of 60,000. Now, the market still reacted on this, but there's still a lot of skepticism about it because the BLS is historically bad at these initial reports, and even though it's likely to get revised lower multiple times, it was a big enough beat that the market still reacted higher as a result. The household survey, which is where they get their unemployment rate comes from, showed that there were 64,000 jobs lost in March, but the unemployment rate dropped from 4.4 to 4.3% due to a reduction in the labor force of about 400,000. So even though there was a net job losses for the household survey, because the labor force shrunk, unemployment rate went down. And always interesting to rectify when you've got the headline number, which comes from a different survey, showing 178,000 jobs created, but then the household survey shows 64,000 jobs lost within the same report. Part of the reason those 400,000 are not being counted is many of them aren't necessarily employed, but they just either stopped looking for work or they're marginally attached to the labor force but still underemployed or unemployed. There's the U6 unemployment rate, which adds those people back into the labor force, and that increased from 7.9 to 8% unemployment rate for the U6. As always, hopefully this is helpful. Hope you have a great Easter weekend here. Take care, and we'll see you next time.